What is the stock market and how does it actually work? The stock market is a marketplace where investors buy and sell ownership shares of companies. Prices move up and down as buyers and sellers agree on what those shares are worth. When you buy a stock, you own a tiny piece of that company and share in its success or failure. How do I start investing with a small amount of money, and which account should I open first? Most beginners open either a workplace retirement account, like a 401k, if available, or an IRA plus a standard brokerage account. You can often start with as little as the price of one low-cost index fund or ETF share. Many brokerages now offer fractional shares starting at just $1. How much money do I need to begin? And how often should I add more? You can begin with any amount once you have an emergency fund and no high-interest debt. Many people automate monthly contributions, for example, every paycheck, so investing becomes a routine habit. Consistency matters more than the amount. Even $50 per month adds up significantly over decades. How risky is investing compared with keeping cash in a bank account? Cash in the bank is very stable day to day, but usually loses purchasing power to inflation over time. A diversified investment portfolio moves up and down in value, but historically has grown more than cash over long periods. The safe choice of cash actually guarantees you'll lose buying power over decades. Can I lose all my money in the stock market? And how likely is that with a diversified portfolio? A single stock can go to zero, but a broad, diversified fund holding hundreds or thousands of companies is extremely unlikely to become worthless. For the S&P 500 to go to zero, every major American company would need to fail simultaneously. The real risk is short-term drops if you are forced to sell at a bad time. What should I do when the market goes down and my account balance drops? For long-term goals, the usual approach is to stay invested and keep following your plan, not react emotionally. Market declines are normal. They happen every few years. Selling in a panic often locks in losses. Historically, every major market crash has eventually recovered to new highs. What is a realistic annual return for long-term stock market investing? Over many decades, broad stock markets have often averaged mid-single to high single-digit returns per year after inflation, about 7%, or roughly 10% before inflation. However, any given year can be much higher or lower, ranging from positive 30% to negative 30% or more. No return is guaranteed, and past performance doesn't guarantee future results. How long does it usually take to see meaningful growth in an investment account? In the first few years, growth mostly comes from your contributions, the money you add. Over 10-20 plus years, compounding, your gains earning more gains, typically becomes the main driver of growth. This is why starting early is so powerful. A 25-year-old investing $200 per month will likely have more at 65 than a 35-year-old investing $400 per month. How do dividends and interest payments work, and when are they paid? Dividends are company profit distributions to shareholders. Interest is what bond issuers pay lenders. Funds usually pass these on to you monthly, quarterly, or yearly, and you can choose to reinvest them automatically, recommended for long-term growth, or take them as cash. Many brokerages offer automatic dividend reinvestment, DRIP. Should I pick individual stocks or use index funds and ETFs instead? Many beginners use broad, low-cost index funds or ETFs as a core because they are diversified and simple. Individual stocks require more research and can be much more volatile. Studies consistently show that most professional fund managers fail to beat simple index funds over time, so there's no shame in taking the simpler, more effective approach. What is diversification and how many different funds or stocks do I need? Diversification means spreading your money across many investments, so no single one can hurt you too much if it performs badly. Often, a small number of broad funds can diversify better than many individual stocks. For example, one total stock market fund holds thousands of companies, giving you instant diversification with a single purchase. What is the difference between stocks, bonds, mutual funds, and ETFs? Stocks are ownership shares in individual companies. Bonds are loans you make to governments or companies that pay you interest. Mutual funds and ETFs are baskets containing many stocks or bonds that you buy as a single investment. The main difference: mutual funds trade once daily while ETFs trade throughout the day like stocks. Is dollar cost averaging better than investing a lump sum all at once? Dollar cost averaging means investing a fixed amount on a regular schedule regardless of price. Lump sum investing puts all available money in at once. Historically, lump sum has often led to higher returns, about two-thirds of the time. But averaging can feel emotionally safer and helps build good habits. Both approaches work. The key is to actually invest rather than waiting. How much should I worry about fees and expense ratios? And what is a low fee? Fees directly reduce your returns, and the effect compounds dramatically over time. A 1% annual fee doesn't sound like much, but it can cost you hundreds of thousands of dollars over a career. Many broad index funds charge very low expense ratios, often well under 0.20%. That's $20 per year per $10,000 invested. Look for funds under 0.20% and ideally under 0.10%. How often should I check my portfolio, and when should I change my strategy? Many long-term investors check monthly or quarterly rather than daily to avoid reacting to noise and short-term volatility. Strategy changes should usually be driven by life changes, new job, marriage, approaching retirement, or shifting goals, not short-term market moves. Rebalancing once or twice a year is typically sufficient. I hope this gave you some value today. If it did, a like would mean the world to me and helps others find this content too. Thanks for sticking around. If you enjoyed the vibe here, we'd love to have you in the community. Hit that subscribe button to join us.